In September 2025, the Federal Reserve is set to make a decision that will directly impact your bank account, your loan payments, and your retirement portfolio. For months, the entire financial world has been holding its breath, waiting for a signal. Now, that signal is here. The question is no longer if the Fed will cut interest rates, but by how much and what it really means for the US economy and for you. Are you prepared for what comes next? It's not just about the markets, it's about your money. Welcome to Smart Money Sense. Over the next few minutes, we're going to cut through all the noise and confusing jargon to give you a clear, simple breakdown of what this Fed rate cut in September 2025 means for you. We'll explain why this is happening now, who the winners and losers are, and most importantly, the exact steps you can take to protect and even grow your money in this changing environment. So, stick with me to the end because the last two action steps are the ones most people will miss. Let's get started. To understand why the Fed is making this move, you have to understand its job. The Federal Reserve has what's called a dual mandate, a two-part mission given to it by Congress. First, to achieve maximum employment, meaning as many Americans as possible have jobs. Second, to maintain stable prices, which means keeping inflation under control. For the last couple of years, the Fed has been laser-focused on part two of that mission, fighting inflation. We all felt it. Prices for groceries, gas, and housing soared, and the Fed responded by aggressively raising interest rates to cool down the economy. Higher rates make it more expensive to borrow money, which slows down spending and, in theory, brings prices back under control. But here's the problem. When you hit the brakes too hard, you risk stalling the engine. For months, all eyes have been on the job market. And the latest reports finally gave the Fed the signal it seemed to be waiting for. The August jobs report came in weaker than expected. But the real story was hidden in the revisions to the months before. It turns out job growth in June and July wasn't as strong as we first thought. Think of it like a company reporting great sales only to admit later that the numbers were actually lower. This trend of a cooling labor market has Fed officials concerned. They see a risk that if they keep interest rates too high for too long, they could push the US economy from a slowdown into a full-blown recession, causing widespread job losses. So, they're facing a classic dilemma. On one hand, inflation is still a little bit stickier than they'd like. It hasn't fully returned to their 2% target. On the other hand, the job market is showing signs of cracking. In this situation, the Fed has decided to pivot. It's shifting its focus from fighting yesterday's inflation battle to preventing tomorrow's unemployment problem. The upcoming Fed rate cut in September 2025 is their first major move to support the job market and attempt what they call a soft landing, slowing the economy just enough to beat inflation without causing a recession. It's a delicate balancing act, and this rate cut is the first step in a new direction. So, what does this cut actually look like? Based on market data from tools like the CME FedWatch tool, which measures what professional traders are betting on, there is a near 100% certainty that the Fed will announce a cut at its September 16th and 17th meeting. The overwhelming expectation is for a 25 basis point cut. Now, that sounds technical, but it's actually very simple. 1 basis point is 0.01%. So 25 basis points is just a fancy way of saying 0.25%, or 0.25%. While a few traders are whispering about a more aggressive half-point cut, the quarter-point reduction is the most likely outcome. But here's what's crucial to understand. Wall Street doesn't see this as a one-and-done deal. This isn't just a single adjustment. Financial markets have already priced in the strong likelihood of at least one, and maybe even two more rate cuts before the end of 2025. The Fed is essentially signaling that the era of high interest rates is ending and that we are now entering a new phase of monetary policy. They are moving from a tightening cycle to an easing cycle. And by the way, if you're finding this breakdown valuable and it's starting to make sense, could you do me a quick favor and hit that like button below? It's completely free, takes about 1 second, and it sends a huge signal to the YouTube algorithm that this video is providing clear financial insights. That helps other people who are trying to understand their money find this channel. Thank you so much for that. It truly makes a difference for a small channel like ours. Now, let's get to the most important part. What does this all mean for your wallet? Every time the Fed makes a move, it creates winners and losers. This time is no different. Let's break down who benefits and who gets the short end of the stick. First, the tough news, the losers, savers. If you've been enjoying the high interest rates on your savings, that party is coming to an end. For the past couple of years, people with cash in high-yield savings accounts, money market funds, and certificates of deposit, CDs, have been earning some of the best returns in over a decade. When the Fed cuts its main rate, the interest rates that banks offer on their deposit accounts follow suit. That $7 trillion wall of cash sitting in money market funds is about to become less profitable. Your high-yield savings account that's been paying you 4 or 5% will likely see its rate drop to 3.5%, then 3%, and so on with each subsequent cut. The era of risk-free high returns on cash is fading. Now for the good news, the winners, borrowers. For every saver who's frowning, there's a borrower who's starting to smile. A Fed rate cut is designed to make borrowing money cheaper, and that impacts the biggest purchases in your life. Let's talk mortgage rates. While mortgage rates don't move in perfect lockstep with the Fed's rate, they are heavily influenced by it. A cut from the Fed generally pushes mortgage rates down. So, if you're looking to buy a home, the next few months could present a better opportunity for a lower rate than you would have gotten 6 months ago. If you're an existing homeowner, this could be the signal to start exploring refinancing options to lower your monthly payment. The same logic applies to auto loans and credit cards. The interest rates on new car loans will likely dip. And while credit card rates are still high, most are variable and tied to the prime rate, which is directly influenced by the Fed. A rate cut should lead to a small reduction in your credit card's annual percentage rate, or APR, which means less of your payment goes toward interest. So we have this clear trade-off. It becomes more attractive to borrow, but less rewarding to save. I'm really curious to hear from you on this. What's more important for your financial goals right now? Growing your savings with high interest, or getting a cheaper rate on a big loan like a mortgage? Let me know your personal take in the comments section below. I read every single one, and I'm excited to see what the Smart Money Sense community thinks. Okay, let's talk about the big wild card, the stock market. The reaction here is more complicated. The simple textbook answer is that lower interest rates are good for stocks. When it's cheaper for companies to borrow money to expand, and when investors can't get good returns in safe savings accounts, they are more likely to put their money into the stock market, pushing prices up. However, the 2025 market is a bit different. This rate cut is one of the most anticipated financial events of the year. It's been talked about for months, and that leads to a dangerous phenomenon called sell the news. Think of it like planning a huge surprise party. The months of whispering and planning are exciting, but by the time the guest of honor actually walks through the door, the moment has already been so built up that the event itself can feel like a letdown. In the market, this means that investors have already bought stocks in anticipation of the cut. The good news is already priced in, so when the cut is officially announced, there's no more positive surprise to trade on, and some investors may decide to take their profits and sell, causing a temporary dip. The long-term direction will depend on why the market believes the Fed is cutting. Is it a proactive move to keep a healthy economy growing? That's bullish. Or is it a reactive, panicked move to stop the economy from sliding into a deep recession? That's bearish. The Fed's messaging will be just as important as the cut itself. And let's not forget bonds. When interest rates fall, newly issued bonds pay less interest. That makes existing bonds with higher interest payments more valuable, so the price of those existing bonds generally goes up. Okay, you understand the why and the what. Now for the most important part, what should you do? Here is your actionable checklist. Action step number 1, for the savers. If you have cash sitting on the sidelines that you won't need for the next 1, 2, or even 5 years, now could be the moment to act. Before rates fall further, look into locking in a certificate of deposit, or CD. A CD allows you to lock in today's higher interest rate for a fixed term. You're essentially freezing that rate in place before it melts away. Compare offers from different banks and credit unions to find the best terms. Action step number 2 for the borrowers. It's time to start shopping. If you're in the market for a home or a car, this rate cut is your green light to seriously engage. Get pre-approved for loans now to see what you qualify for. Lenders will begin to adjust their rates, but it might not be immediate or uniform. Don't just take the first offer you get. If you have existing high-interest debt, like on a credit card, look into balance transfer offers or personal loans, which may soon have more competitive rates. Action step number 3 for the investors. The single most important phrase here is do not panic. Your long-term diversified investment strategy should not be derailed by a single, highly anticipated Fed announcement. The market may be volatile in the short term. It may go up, or we might see that sell the news dip we talked about. Resist the urge to make emotional decisions. If your financial plan was solid yesterday, it's still solid today. This is a time to review your portfolio, rebalance if necessary, but not to make drastic changes based on headlines. Action step number 4, review your personal inflation rate. While the government talks about the national inflation rate, what really matters is your personal inflation rate. How have prices for the things you buy changed? Use this moment to review your budget. Are you spending more on gas, groceries, subscriptions? A rate cut might make borrowing cheaper, but it doesn't magically make everyday goods cheaper. Understanding your personal cash flow is the foundation of every smart money decision. Action step number 5, educate yourself for the next move. This is not the last time the Fed will make a big decision. Remember, markets are expecting more cuts. By watching this video, you've already taken the most important step. Continue to follow reliable financial news, not the hype, but the actual analysis. Understanding the why behind these moves will make you a more confident and successful manager of your own money. So that's the clarity behind the Fed rate cut in September 2025. It's a major pivot from the Federal Reserve, a move designed to protect the job market, which creates real-world opportunities and risks for your money. If you believe in making finance make sense, join our community by subscribing so you never miss an insight. For more clear analysis to help you navigate this economy, check out our playlist on budgeting and personal finance tips right here. Keep building your sense. Thanks for watching, and I'll see you in the next video.